Investment checklists have become staples in the investing process for many of the people whose portfolios I follow, whose books I read, whose investment talks I watch, and it's something that I've tried to implement in my own investment process in the past year or so. A couple of key people that really got me interested in using an investment checklist include investors like Guy Spear and Monish Prabrai, and about 10 months ago here on the channel, I shared my own investment checklist. Now, the purpose of that video was really just to provide an example of what an investment checklist might look like. These checklists really are very personal, and they're designed to basically pick up potential mistakes that you are prone to making as an investor, areas where you've seen other investors kind of screw things up in the past, and the checklist items aren't going to be the same for all people. I'm going to pick up things that you might miss, you might pick up things that I might miss, and therefore our investment checklists do have to be different. But I think it is kind of interesting to work through some of the items that other investors have on their particular checklist. And in this video, I actually want to go through my own and use an example company, THO Industries, just to show you what that process of going through the individual items on the checklist look like. It helps me to pick up some of the red flags. It helps me to get basically clarity of thought about how this particular company might stack up versus other investment opportunities that I have. And hopefully it's a good learning exercise for everyone watching this video. And the company I'm choosing to use here really is just for example purposes. This isn't meant to be a buy or hold or sell a recommendation or anything close to that. I just think it's much more meaningful to use real companies in some of these videos than just to kind of talk about things theoretically. So that's the topic for today's video. I'm going to work through my investment checklist item by item and show you how this particular company scores, and also take you through some of my notes and the things that I am thinking about as I work through this process. But before we get into that, we do have a sponsor for today's video, and this video is sponsored by Hatch. Hatch is the platform that I personally use for all of my US investing for me as a Kiwi based here in New Zealand. Hatch is asking you to think about what your big and small tomorrow goals look like. For me, the goal has always been financial freedom, putting a little bit away today with the aim being that I can do the things that I want to do tomorrow. Everyone's tomorrow looks different, whether you want to buy your ultimate dream car, travel the world, or become financially independent. Reaching your goals starts by taking the first step. That's why I invest with Hatch, to help make my plans a reality. And if you want to get started investing with Hatch, check out the first link in the description, where you can get a free 20 New Zealand dollar top up when you make your first deposit of 100 New Zealand dollars or more before the 31st of December 2022. Now, if you saw my checklist videos about 10 months ago, then you have probably already seen the general layout of this checklist. It basically goes through Phil Town's kind of 4M checklist of meaning, moat, management, and margin of safety, and I've obviously added some specifics. And for THO in this example, I have also added a whole lot of notes around each kind of point on the checklist. So that's kind of the general layout. I've given myself a few examples of kind of things to think about as I'm working through each item, and then I basically give it a pass, fail, or kind of a question mark, or sort of something I need to look further into. So let's just kind of start from the top and keep working through. So in terms of my questions around meaning, the first one is, are there temporary tailwinds enhancing free cash flow? And for THO, there actually certainly are. They had a big tailwind coming out of COVID. They produced record free cash flows, and although THO is does have a very long track record of growth, it was a huge up year, and you do have to kind of do some normalizing with these more cyclical companies. And although it scores a question mark on that, are temporary tailwinds enhancing free cash flow, because they probably are, or they almost certainly are, I think the normalized free cash flow for THO still looks strong. Moving along here, does the business produce cash, not just accounting profits? That's a strong yes for THO. They produce free cash flow even in a huge downturn like 2008 and 9. Could domestic or foreign competition ruin the investment case? I think that's unlikely. THO has about 40% market share in the US. They also have, I think it's about a third market share in Europe from a big acquisition. And the industry outside of a couple of key players that have done some consolidation, THO being a major player there, outside of that, the industry is very fragmented. So it's unlikely that there's going to be one kind of new competitor just come out of nowhere and take over the industry. So I've gone a pass for that one. Can I list the key factors that allow me to make sure the business is on track? Yes, we've got wholesale RV unit growth. There's industry data that's published all the time so that we can keep an eye on that. Market share, gross margins. THO have target gross margins, and they share their market share stats basically every quarter. Order backlog, dealer inventories, long-term earnings, because they have published some 2027 earnings targets, and sticking to their capital allocation plans. They've got some targets around buybacks and debt repayment and so on. So yes, I certainly can list those. Does the business have pricing power, and or is it a low-cost producer? I think probably the best sign here is just to look at their gross margins over time. So far, they've had no issues at all passing on higher prices during COVID. And I've just got a note here that they're a duopoly, or there's probably kind of three big players really in the industry. Are future capex requirements reasonable, and will they earn a high return on invested capital? This is an interesting one. So THO traditionally has acquired RV brands over the years. They said in a recent investor day they basically won't deploy capital in acquisitions unless it can earn about a 20% return on invested capital. So great to have management kind of thinking about it in that way. And although it's more of an acquisition answer that I've given here as opposed to capex, yeah, things are pretty reasonable. I really have no major concerns there. Now, our second question mark here for THO, does it have a long runway? This is a really interesting one. The long runway question is obviously essential for very long-term growth. And in terms of market share gain, THO have probably done a lot of the growing already, to be frank. So if I said for brand growth and gains in market share, possibly not, or probably not is what that should really say. But for buying back and retiring shares at low multiples of earnings, they definitely have a very long runway. And they probably have quite a runway yet in terms of acquiring parts businesses as opposed to RV brands, which they've done a fair bit of recently. But it is a question mark. The runway certainly isn't as long as it once was. So does the business have a clear and durable advantage over competitors? So we're moving into the moat section now. I would say THO has a relatively weak moat. It's not like a toll bridge moat or as strong a brand as like a Apple or Ferrari or anything like that, but they do have a number of high quality brands. They also have pretty significant scale in the industry that allows them to do bulk purchasing of things like chassis for a lot of their motorized products, and that certainly is an advantage. They have like a pretty decentralized kind of management structure with all of the individual brands operating reasonably independently, but there is some stuff that is centralized, like that bulk purchasing of chassis, just as an example. So they're not the moatiest business in the world, I would say, but that certainly is a company with some advantages. So could the moat be breached with enough money or technology? I've got electrification as a risk, but tollables helps, and the risk in capex is outsourced to Mercedes. So the kind of prompt I've got there is to think of something like BlackBerry. Obviously, the iPhone killed that, and IBM has really been disrupted by technology and money with probably not moving as quickly as they should have into cloud software type areas like the likes of AWS and Microsoft and so on have. So I think the risk's pretty low overall with THO. I've seen electrification as a risk, but they have a lot of tollable products, so that's not like they're producing internal combustion engines that they have to then convert to electric vehicles. That's kind of outsourced to the people buying or producing the actual vehicles that tow THO products. So something to keep in mind, but not a major. And in terms of the motorized products that THO has, they're often using like Mercedes chassis and engines as like a platform. So to a large extent, that issue is outsourced to like the OEMs and traditional automakers. So that's my thoughts there. Can an idiot run it? They have decentralized operations, so they have kind of CEOs, a little bit Berkshire Hathaway-esque at each of the RV brands, so that helps a lot. The founder's still on the board, so we probably haven't seen whether or not an idiot can run it just yet. I don't think Thor's really been through that test, but I think, no offense to the current management team, they're pretty set up to be durable in that respect. Moving now to the management section. Is management compensation egregious? CEO compensation is around $20 million. It was $9 million in 2020. And one thing that I really like here is that it's mostly cash. There's not a lot of equity awards or stock options kind of diluting shareholders, even at the kind of upper management scale. So there's a small amount of that, but it's pretty limited. It's mostly cash, and $20 million is a huge amount of money, but kind of is what it is. I don't think it's anything crazy, and Thor can definitely handle that level of compensation, I guess, is a reasonable way to put it. So are management incentives aligned with shareholders? So I guess in terms of stock ownership, the chairman of the board, who is also one of the co-founders of Thor, has a massive investment, about $150 million in stock as of kind of last checking. The CEO also has about $16 million in stock. There's been a few open market purchases from various people in the management. So the only kind of not red flag but yellow flag here, I guess, I've got is the new chief operating officer seems to be talking a little bit more promotionally, talking about how our shares are super cheap and buybacks are the best use of capital, and that may be true, but I'm not sure if I quite like the way that that's communicated. Sometimes it sounds a little promotional for my liking, but overall I think there's pretty good alignment with shareholders. Insiders buying. The founder bought $1 million of stock in January 2022 at $98 a share. Thor currently trades in the 70s as of recording this video. And they bought another $1 million in June 2022 at approximately $75 a share, or current share prices. So, this is a man with about $150 million stake, so to add $2 million isn't anything crazy, but, you like to see it. So that's a good one for sure. Next up, are management unreasonably diluting shareholders? There's been some dilution over the years. There was a little bit a couple of years ago to do with the big acquisition of the Uhlenheimer Group, which is Thor's European business. So that caused a little bit of dilution, but very minor in the grand scheme. And it seems to have been certainly under like 0.5% a year, like 0.2 to 0.3% per year. So next to no dilution, although there's a modest amount. And in their recent investor day, they said they've got plans to buy back about 14% of their shares between now and 2025, and that assumes quite an increase in share price apparently as well. So the exact opposite of dilution happening basically. There'll be a net buyer of stock over the next few years. I would be pretty confident in saying that. And finally, for management, is the strategy for allocation of surplus capital clear? Yes, they lay that out in all of their investor presentations every single quarter. They gave a lot more detail in the recent investor day, so they look to reinvest internally. They do have quite a focus on paying a growing dividend over time. They want to pay down debt, do acquisitions, although they have said that there won't be any major acquisitions in the next few years because their stock looks more interesting. So there is certainly a clear surplus capital allocation kind of intention towards buying back a lot of stock. Moving now to the fourth and final M in our 4M checklist, which is margin of safety. Is the stock cheap enough in absolute terms, not just relative to others in the industry? Now, this is a checklist item I actually got from Guy Spear, so I believe he wrote about this in The Education of a Value Investor. Just because something's trading at 30 times earnings and their peers are trading at 40 times earnings doesn't mean it's cheap. It's still trading at 30 years worth of earnings, assuming that the earnings don't grow. So it does have to be cheap in absolute terms, and I've looked at that for Thor in a couple of different ways. So they're currently trading at a PE of less than 4, although admittedly that is off very high earnings. If you normalize those earnings out to about $500 million in free cash flow a year, that gives us more like about 8 times normalized free cash flow, or about 11 times or so on an enterprise value basis. So that's kind of where I've got to with that, although I have indicated here that free cash flow is likely to be a lot higher over the next year or two than that 500 million. So again, that'll go towards debt repayment, towards share buybacks and so on. And looking at things through a slightly different lens, like book value and return on equity, kind of comparing those two things. THO is currently trading at about 1.2 times book. In August 2019, one of the last big downturns that THO had, 1.2 times book is about the lowest they got to. And during the COVID lows, they got to about 0.9. During 2008 and 2009, I think they got to about 0.9 times book value as well. So all of that is to say, yes, in absolute terms, it looks cheap, at least by my assessment. Does the company have sufficient liquidity to meet their debt obligations? Pretty quick yes, with looking at a couple of ratios there. Could a short-term event significantly impact the ability to meet debt obligations? No, they've given some simulation kind of examples in recent investor days on that as well. Are revenues dependent on credit markets or the price of a particular commodity or similar? Not really, although I probably should have added some notes here, and that's maybe a potential yellow flag I should go back and change here, but I guess their customers are a little dependent on credit markets. They often finance these RV purchases, so maybe that's something to add in here, but I have given it a pass for now. Am I likely to have a permanent loss of capital? The business produces strong cash flows. I think the valuation is pretty reasonable, so I've gone with no. And finally, for margin for safety, is the downside small and the upside huge? I have intrinsic value conservatively at $130 a share. They've published 2027 targets of $27 a share in earnings. Historically, they've traded a multiple of 12 to 15 times earnings, so that implies a $300 to $400 share price in about 5 years versus about $70 today. So certainly some upside there, and I guess in terms of downside, the all-time low price to book on their current book value would imply about a 30% decline from here to about $52 per share. So yes, in my view at least, the downside upside seems interesting. Now I do have a few final checks in here, so let's quickly run through those. Is it a cinch? Is it a no-brainer, as Charlie Munger would call it? I haven't actually given it an answer there, but or I haven't added notes, but I've given it a pass. So each to their own, coming to a conclusion on this particular company, but that's a question I do like to ask myself. Could operational leverage quickly ruin the investment case? So this is a learning from my previous investment in Fiat Chrysler where that happened. And technically yes, but there's a big order backlog, which certainly helps. And they're not the kind of company that will go hugely cash flow negative in a downturn. They've actually been profitable for more than 40 years straight. So no huge concerns there. Do other smart investors own it? And that's not intended to be worded that I'm a smart investor or anything, but do other people own it? Not really, but Norbert Lu was in Winnebago, which is in a very similar business to THO. Warren Buffett at Berkshire Hathaway owns Forest River, which is kind of the third player in the industry. And Tweedy Brown has a small position in THO as well. Is this way better than the index, or should I just be buying the index? Well, let's say above average business at a below average valuation. So hopefully that answers that question. Is this almost certainly better than your other holdings? Now, this is a question that I actually often spend a little bit of time on, and it changes with prices and the opportunity set at the time. Right now, it's probably my highest conviction idea. Potentially has more downside protection than some of the other stocks I'm interested in, although possibly not the same upside as something like an Alibaba, just to put an example out there. So that's a question I kind of go through. And along similar lines, would you rather own more of an existing investment? Think about the upside, the downside risks, and your confidence level. I would possibly want to own more Seritage. I'm pretty maxed out on Alibaba. Nothing else seems super interesting. Is this the best opportunity I've seen all year? Again, some potentially slightly riskier stocks and areas could have more upside, but we've got to consider the downside as well. Would I be confident putting 20% of my net worth into this position? Do it in a heartbeat if the price was right. But again, that's just me. This is just an example. What would Charlie and Monish do? Well, Charlie owns an RV company already via Berkshire. What would Warren do, including the early Warren? It's a solid base hit type investment. He'd do it, I think, at least. And again, he's bought Forest River before, so there's a bit of confirmation bias for me. And does a 5% position feel above the knees? So that's taking Guy Spear's analogy of, how far underwater are you, or how far is the water kind of up your body? And a 5% position feels, way down low at the ankles, maybe even lower than that for me. So certainly no issues there either. So that was an example run through of my own investment checklist. Now, like I say, everyone's investment checklist is going to be different. It should be different. We will each get caught up on different things, or maybe forget to look at different things. But as you can hopefully see, there's a lot of kind of background research that's going to be required for you to work through your own investment checklist. There will be things that will cause you to stop, go, actually, I don't know the answer to that question, and go and research it. And sometimes that might be a time-consuming bit of work to find certain things out. Other times it will be quite straightforward, and it's something you can very quickly find in an annual report or a quarterly report, or on a basic kind of financial tool that gives you stats about that particular stock. So I hope you did enjoy that example. Let me know your thoughts on it down in the comment section below, and if you did enjoy it, be sure to hit like and subscribe. But that is it from me for this one, and I'll see you in the next video. Cheers.